Hello everyone, my name is Parshalavadi and on behalf of Group 24, I am pleased to begin our presentation based on the book The Unusual Billionaires, written by Mr. Saurav Mukherjee. Before understanding what a coffee can portfolio is, it is important to understand two psychological and economic concepts discussed in the book: halo effect and Pareto principle. Halo effect is when people see one strong positive trait about a company, be it strong brand or popular promoter. They automatically assume everything else in the company is also good. Author warns investors that this bias may often lead to poor investment decisions because people stop analyzing deep numbers deeply. Pareto principle, also known as 80-20 rule. It suggests that 80% of the wealth in the stock market comes from 20% of the companies. These companies consistently outperform others in the long run. Using these two ideas, the book introduces the concept of coffee can portfolio. Just like in the ancient time, people used to save their valuables in a coffee can and forget about it. Coffee can portfolio involves buying a few extremely high quality companies and holding them without frequent buying and selling, allowing compounding to do its work. Now the question is, how do we identify such rare and high quality companies? For this, the book has given us various financial filters, which we will discuss in the next slide. Firstly, the minimum market capitalization should be more than 100 crore, and a company should have at least 10 consecutive years of performance. The significance of this requirement is to ensure that the company has survived multiple economic cycles, including downturns, inflation, and policy changes. The next filters are different for both non financial companies and financial companies. For non financial companies, it should at least have 10% revenue growth each year and at least 15% ROCE each year. The reason behind this 10% revenue growth each year is if average nominal GDP of last 10 years of our country is growing at 10% each year, these companies should also have a minimum growth rate of 10% in its revenue. The reason behind 15% ROCE is that the interest individual can earn by investing in US bonds for 10 years and adjusting it with India's risk by adding country's premium and with India's equity risk premium. We can also get this number by adding India's equity risk premium to India's 10-year bond yield. For financial companies, it should at least have 15% loan growth each year and 15% ROE each year. The financial companies who have steady loan growth of 15% each year despite ups and downs of business cycle outperform its competitors. In fact, they even perform better during economic downturns. ROE growth basically ensures the efficiency of shareholders' equity being used by the company to generate net profit. So finally, we must know that wealth is created by owning a few extraordinary businesses rather many average ones. And with that, I would like to hand over the presentation to Asim, who will take you through the next topic. Thank you.
So, hey guys, my name is Asim Mansoori, and I will be explaining you business strategies. So, there are a couple of businesses explained in this book by the author, Mr. Saurav Mukherjee. The very first business is that Asian Paints. Asian Paints has applied various business strategies to become successful in the paint industry. The very first strategy is that they have hired their employees who from IIMs, and they have changed their selling side from industrial sector to retail sector by changing their packaging from bulky tin cans of paints to a small packet plastic packages of paints. And Berger Paints has also applied sort of same strategy to become successful in the paint industry. But a different key strategy from the Berger Paint side is that they have hired the CEO who are veteran from only in paint industry. One interview with There was a one interview with Berger Paints promoter and author. The promoter has said that we hired only veterans from the paint industry as the CEO because we believe that a person from another industry will ruin our business. The third company that the author has explained is Marico. Marico has divested some low margin businesses and focused more on their key products and key businesses. They have invested more into their key products and key businesses. They have divested Sweaker and SIL due to their low margins and invested more in Saffola and Parachute. Can we have the next slide? So another business strategy that all the companies has applied in this book, according to this book, is that they have focused only on their core business. Like Astral, Astral has focused and allocate their capital into only their core business. Astral has created a plumber network. The promoter of Astral, Sandeep Engineer sir, has created a plumber network which gives certificates to plumbers and train them in an efficient way so that they become efficient in their work. The two banking companies in explained in this book are HDFC and Axis Bank. For the banks, low NPA is the main goal. Low NPA means non-performing assets. Non-performing assets are such borrowers who stop paying their debt. So Axis Bank and HDFC Bank has tried many strategies to reduce their NPAs and invested more into IT technology to make their bank core banking. Can we have the next slide? So as I have explained, Astral Poly has trained the plumbers and given them certificates so that they build a plumber network. Because if we have a huge plumber network, we can become successful in the pipeline industry because plumbers decides and influence the customers' demand. And another business that is explained in this book is Page Industry. Page Industry's business strategy is that they have never sell their products with discounts so that they can sell that products on MRP and generate more profits. And they always try to remove low performing SKUs and innovate their product in an efficient manner. So I would like to handle the rest with Mihika.
Hello everyone, my name is Mika Mundra and today I will be going to explain the competitive advantage and innovation. Please change the slide. Please change the slide. The four pillars of an unbreakable moat, which means competitive advantage. It is the ability to achieve better than its competitors and which cannot be copied easily. First, strategic network and platform control, it which means owning and controlling the platform which depends on the others. For HDFC Bank, they provide fast settlement transactions between dealers and platform as preferred NSE clearing bank. Second, unmistakable product and design differentiation, which means the high quality product better than its competitors. So Astral Poly, it innovated CPVC pipes, which is the replacement of traditional GI pipes and has high quality and noise free. Third, operational and supply chain supremacy, which means a company a company better in its operations and supply chain. So Asian Paints utilize its past data for analytics and understanding the forecast demand. For Page Industry, it has low labor attrition rate, which is 12 to 13%. Fourth, dominant and enduring trust, which means the which means the customer has high trust on the brand. Please move to the next slide. The next part is innovation. For product innovation, it means the enhancing the value of product or improving its existing quality. Asian Paints launched washable distempers with different colors, sizes, and grades. Second, Marico, they transformed their packaging from tin to plastic, and Berger Paint created a premium product segment, which is uh, Luxol, Silk, and Illusions. For process innovation, it means redefining your business through process. Asian Paint and Berger Paint both introduces the tinting machines, which reduces the tinting time and improves its inventory management. System innovation, which means it is it means transform its technology, just like Marico does. Please change the next slide. Expanding the horizon into entering new segments and creating value experiences. For Page Industry, they successfully transformed their men wear into women and leisure wear. Marico ventured Marico oil segment into the into the oats and skincare. Thank you. Now Vasu will explain.
Hi guys, I am Vasu Ramani. Today I explain about branding and architecture. Now I start from branding. Branding is one of the important things for company. Strong branding recall for company is a more important. If company haven't a strong brand recall, then company cannot achieve their goals and objectives, and company can also not achieve their outperformance, and company can never become a great company. So branding is not just about famous, but it is about the quality of product and quality of their promoter in their companies. The seven company has a strong brand recalls like Page Industry has spent 5% of their revenue in premium advertising. Asian Paints has done for iconic Gatu to mascot to modern campaigns, and Maricoa has done for Saffola oil, which preventive from heart attacks and also take care of heart patients. And they have also done for Parachute oil, which improving product packaging from tin to plastic, which also looks more attractive. Now I want to explain architecture. Architecture is one of the important component for the company. Strong architecture structure is necessary for company to increase their internal efficiency. Without efficiency, company cannot achieve their goals and objectives, and also become not an and also become it cannot become a great company. Architect, uh, the company should be make a positive, optimistic, and uh, environment for employee, and they should be make strong relationship with their suppliers, dealers, and distribution. The seven company has a good architecture strategy, like Asian Paints offering uh, rapid career progressions. Berger Paint has for best discounts and attractive deals. Axis Bank has built employee-friendly cultures. HDFC Bank has culture of adapting early new technology. And last, Astral Poly has expanded their distribution channel and train their employees and plumbers. Now I would want to call my friend Josh Modi, which continue the presentation.
Hi everyone, my name is Jose Modi, and my today's topic is strategic asset. Strategic asset is a valuable resource or capability that gives a company a long-term competitive edge, aligning with its core mission and goals, difficult, making it difficult for rivals to intimidate and crucial for enduring success. Uh, Now we will taking four companies as an example. Our first company is Asian Paint. Asian Paint, they have one of the highest ratio of revenue per depot by bypassing wholesalers and dealing directly with over 150,000 plus dealers. They created a distribution web that competitors find too expensive to watch. Their trucks delivers to dealers 3-4 times a day, making it physically impossible for a new entrant to offer better service levels. Our second company is Berger Paints. Berger Paints is as similar as Asian Paints. Berger's strategic asset is its entrenched network of tinting machines. Once a dealer installs a company's tinting machine, they are unlikely to switch to a competitor, creating a locked-in physical asset at the rental point. Now, our third company is Marico. uh, Marico. For their flagship product, Parachute, Marico established a massive direct from source procurement network for Copra. Their ability to manage the violet commodity piercing of coconut oil through sophisticated program and hedging mechanism service as cost advantage assess that similar players cannot replicate. Now our fourth company is Page Industry. Page Industry holds the exclusive license to manufacture and distribute the jockey brand in India, Sri Lanka, Bangladesh, Nepal, and UAE. This strategic assess that prevents any other player from one of the world's most recognized innerwear brands in the territories. Now, I would like to call Asim to hand over the next part.
So I would like to call about key growth triggers that the company initially helped that these triggers helped the company to grow in their initial phases. Like Asian Paints, it was time of World War II, which has made Asian Paints initial growth. Like ban on import on paints helps Asian Paints to grow. Burgess Paints grows through industrial corrections. Marico has capitalized and done a backward integration. Axis Bank was benefited by a government body, which was UTI. So Axis Bank was backed by a government body, which was UTI, which helps Axis Bank to gain the license of banking license from RBI. Uh, SGFC Bank was driven by the leadership of Puri sir, and when it comes to Page Industry, it was backed by the licensing of Jockey, which was expanded for 20 years. And when it comes to Astral Poly, the key growth trigger was the relationship with the plumbers and Sabbir Merawala sir, who trained the plumbers in an efficient way. So, thank you. I would like to call Mokshil to present the next slides.
Hi guys, I'm Mokshil. Thank you, Asim, for the warmthness. I would like to start my presentation by giving a statement that success is not everyone's cup of tea. Because a greatness of a particular company is depends or it does not depends on how much the company is old or how many years it have presented their products or in their top shelf. It is depended by their continuous growth over the long periods of time. The greatest definition can be broken down into 3 points. First, that is unwavering focus. The core focus of the company on their core products and to deliver their core products in a very useful manner to their consumers so that the quality does not get degraded over the years and the quality keeps on improving day by day. The second is deepening the moat, which means the company's architecture, the company's work culture, the company's brand value, the company's brand recall. It all includes in deepening the moat. It includes that how the company is presented by itself and from a point of view of the consumers. The third point is sensible capital allocation. To the company, uh, the place where which the company allocates their capital can be known by this point. For example, they allocate capital in acquisitions or their core business or some mergers to expand their business and to grow business at national or at international levels. We can see that the first among equals company, which is given in the book, which are the seven companies, and the average Nifty company, we can see their comparison where from where they got money. For example, 82 percentage of uh, FAE companies are from cash from generations, and they realized only 3 percentage debt. But while average Nifty company 53 percentage is from cash from operations and 34 percentage are debt raised. So it is a very debt heavy companies in Nifty and rather compared to first among equals. And they reward better than Nifty company. FA companies give 39 percentage dividend to the shareholders, which maintains a high ROCE levels compared to Nifty companies because they only give 11 percentage dividend to the shareholders. And then the investors checklist, which means if we have to invest in a company, we have to tick this 3 points at a base level,
to do investment in that company. First is industry attractiveness. We have to ask various questions, which is given on this slide to the company, and which if it fulfills the questions and satisfies our soul, we should invest in that company. Second, the management quality. The management of that particular company, the top level, middle level, or the bottom level management should be very transparent and should be free from any fraudulence or free from any cases, and should provide all the following information. So the management quality should also be that. And third, the competitive advantage. The particular company which we would invest in, that company must have a competitive advantages in compared to its competitors. It is a must think, and if the company takes all the 3 points, we have to invest in that company surely. Now I would like to invite Bhavya for the final conclusions.
Hi, this is Bhavya Shah. So I would like to draw your attention towards when we value any company, valuation doesn't only depend on the fundamentals of the company. It depends on how peers are comparing and how companies placed as compared to the peers. So now I would like to draw your attention towards what peers have done mistakes that would help the companies become great. So the first mistake is capital misallocation through unrelated diversification. So when we look at Berger Paints, and some company has done capital misallocation, then complacency and shedding the lucrative markets, frequent changes in ownership leading to a strategic discontinuity. Berger Paints has see a lot of change in leadership, understanding the brand loyalty of an enriched competitor. So HDFC has seen a lot of royalty, remain trapped in a commodity mindset, competing primarily on prices. So HUL has trapped in a commodity mindset and had done mistakes in the prices. Now, when we look at Berger Paints, so Berger Paints and some companies like Garwade Paints, Jensen and Nicholson made a mistake in capital allocation. Then we can see that Marico and HUL war. HUL attempt to dislodge Marico's parachute brand. Then we can see Page Industries. Major competitors were in mid-premium segment, and Page Industries focused only on core segment. Can you please change the slide? Now the flywheel of the engine of enduring greatness. So a business is depend on how capital is allocated. So we will look at how capital allocation within these seven great companies has helped them achieve the greatness. Now, Asian Paints allocated capital efficiently without taking much of the debt, and funding their capital expenditure through internal accruals and using tech. Then Berger Paint. Berger Paint keep focusing on one business segment rather than going and diversifying and investing the capital in one segment and make it more efficient. Then Marico. The core FMCG business is highly cash generative with low capital intensity. Then we can go to Axis Bank. Axis Bank has maintained good ROE. So they shift to retail apart from banks like ICICI, they focused on retail loans. We can see that ICICI uh, had uh, see a lot of NPS due to the loan book of corporate loans. HDFC Bank. So HDFC Bank always preferred prudent and safe loan growth. When after the before the Lehman Brothers crisis, many banks had a lot of NPA due to the uh, lower CIBIL in borders. But HDFC Bank give loan to the credit worthiness people. Uh, Thank you so much for giving attention to our group. Uh, this I hope this Coffee Can Investing book by Saurav Mukherjee will help us identify great stocks. Thank you.
Thank you. Thank you.